Okay, it's 11 o'clock. I think we're going to go ahead and get started. I want to welcome everyone to the Stockyards Bank Wealth Management WebEx series, The Bright Ideas. I think this is our fourth one, and I feel like, what are we, day 30-something of quarantine or Groundhog's Day, however you want to look at it. It's sunny out, at least here in Cincinnati. It's warm. Things are looking brighter out there as we watch the news. We see here, the news has gotten a little bit better. Less bad news, some brighter things out there as the economy and states start to attempt to open up, which is exciting, and we'll kind of see how that plays out over the next few weeks. Excited today about today's WebEx. I think it's going to be a different style, so we're going to do kind of an interview of two individuals, Matt Wilson and Keith Blakely from our investment team. Matt will interview Keith and go through some things, and we kind of ran through this yesterday, and it was exciting. I thought it went really well. I think the feedback for those that are calling in and listening, you're going to really enjoy the commentary. And then the second part of this, I will interview Jon Sanders, one of our mortgage loan originators. And we're going to talk about mortgage rates and where they've gone, what COVID-19's done to the mortgage world, kind of where we see that going. And if you're someone out there that's been thinking about a refi, hopefully you'll get a question answered through today's commentary that'll help you decide whether that refi might be right or may not be right. So with that, I'm going to turn it over to Matt Wilson, again, from our investment officer from our investment team, and he's going to take over from here. So, Matt, it's all yours.
Jason, thank you. Good morning, everybody. Welcome back again. I am particularly excited this morning because I have the great pleasure of interviewing somebody who I respect and I've learned a lot from. Mr. Keith Blakely is a financial advisor at Stockyards Wealth Management. He's been with us for at least 7 years. It's probably been 8 years by now. Keith holds the Chartered Financial Analyst designation. I want to take just a second to highlight that. That is an extremely difficult designation to obtain. There are 3 very difficult tests that you have to pass, tons and tons of criteria. This designation is only held by 2 people at Stockyards Wealth Management, Mr. Mark Holloway, who many of you know, and has recently announced his retirement coming up this summer. So Keith will be the only person at Stockyards holding that designation. And it's typically used by industry professionals and more specifically portfolio managers. So I'm happy to have Keith. He's an investment advisor here. He's a member of our management team, and he's one heck of a good golfer. I think he's a 2 or 3 handicap. So Keith, welcome to the show.
Hey, appreciate it, Matt. Thanks for having me on here.
Absolutely. So the economy is not great. We've seen 26 million people file for unemployment benefits over the past 5 weeks. And it's not looking too good. Jason said we're seeing some signs of optimism, but kind of walk us through, what we've seen and where do you think things will go from here?
Okay. Yeah, absolutely. So I think it's important to start, where we've been and why did the market trade down so much and why has it traded up so quickly? So what we're going to do, we'll go ahead and start on this slide right here. And what this slide is showing is it's showing it's isolated all the data for the state of New York, and obviously a big epicenter for the coronavirus. And what it's looking at is just looking at projected hospital beds needed. So obviously cases that would certainly, be serious in nature. And so March 26th. So again, when things were really, really bad, I want to say the market was down, 30% at this time. You'll see this gray line kind of in the middle here, and I've got my highlighter out here for you, Matt. So projected hospital beds needed as of March 26th, somewhere around 50,000 or so. And what happened is as time went on, as we went on a couple more days, April 1st, that line increased, or that projection increased all the way up to about 80,000 beds needed in the state of New York alone. And now this phenomenon was happening across the country. So again, I think it's really important to show just how bad these scenarios were looking. And then we fast forward just basically through a weekend and things all of a sudden just, got better. The picture got much, much rosier. Instead of projecting 80,000 hospital beds, that projection went down all the way down to, let's call that 25,000 or so. And obviously you can see that as of, this is just a week ago, April 21st, that projection has continued to decrease just a little bit. But I think the other important point is that we've actually seen that peak in the virus. And so that was obviously a huge, huge sign that the market was looking for. And I think that's why we've seen such a strong rally. I think we're up, 25% since those March 23rd lows. And another interesting point is obviously, why did this curve flatten so much? And you'll see in this chart again. I found this chart off the Wall Street Journal. We implemented stay-at-home orders, or at least the state of New York did, on or around, kind of late March. So clearly, it's either and probably a combination of both. Social distancing has actually worked, and it truly has flattened that curve that much, which is absolutely amazing. Or probably the other side of the story is expectations were quite frankly too dire. And so I'm not sure which one weighs a little more heavier, but either way, we're certainly grateful that we didn't get up to those peak numbers that were originally projected. So certainly that's why the market has traded up so much. And obviously, if we can keep that trend going, keep other states looking similar to the state of New York, and obviously get this number down, I think, as Jason said, we may be able to start reopening some businesses in mid to late May, which would be a good sign. So, Matt, I'm going to take you to this next chart, which is a chart of GDP estimates by all of the investment banks out here. And I'll let you kind of take it and figure out what you want to do from here.
Wow, that's kind of a scary chart when you look at all the red there in the first and second quarter.
Mm-hmm.
So what we're looking at here is a projection for the growth of the economy for the all 4 quarters of the year. The first 2 quarters are looking negative, and so that would definitely be a recession.
That's what it looks like. And again, I want to caution you, all of these estimates are as of April 3rd. So again, I think it's pretty well set in stone that the first quarter we are going to have a negative number. I think most of these projections, seem fairly accurate. It's probably going to be somewhere between, 3 to 5% negative growth in the first quarter. And I don't think there's any question that the second quarter is going to be negative. So certainly, it looks to us like we're going to have a recession. But, just given that these estimates were done as of April 3rd, we could see how bad numbers looked as of April 1st as far as, where this virus was going, how long it was going to take for these numbers to come down. I would venture to guess that most of these numbers are probably going to be overstated if we look today. And I was not able to find anything updated from all of the investment banks. I would think somewhere, maybe Citigroup might have a reasonable estimate here. I don't think we're going to see the 25 to 35% drop in GDP growth in the second quarter that, we were talking about, as soon as or as recent as 2 weeks ago. So certainly that's good news for everybody. That's good news for just the economy as a whole, because we're not going to get that 25% drop that you see, Credit Suisse and JP Morgan have on this chart. We're also not going to get that, double-digit bounce back in the third quarter here. Again, it's going to be probably a softer drop and probably a softer, recovery here in the third quarter. But again, very interesting numbers here, and certainly we're interested to see when these reports come out, what they look like.
Well, when we started shutting down the global economy, we all assumed that the numbers were going to look pretty rough, and you can see those are very, very big numbers there, and hopefully it comes out better than expected. So the problem I have is the economy is not great. 26 million people unemployed. We see massive, massive declines for the economy in the first and second quarter, and the stock market is up 25, 30% in the past month.
Yep.
Why?
Heck of a question. Couldn't, we should have all seen it before, right? But, actually the market bottomed and market bottomed essentially on March 23rd. And again, assuming we don't have any type of double bottom coming out. And let's think about that March 23rd date. So the CARES Act, the major stimulus bill that you and Jason spoke about a couple weeks ago, that came out actually on March 27th, so 4 days after the bottom. the Federal stimulus, the Federal Reserve stimulus that they released came after that March 23rd bottom. And again, what everybody was so interested to find was the peak in viruses, which again looked to be somewhere in that early to mid-April. We actually had April 1st projections go up. So again, the market bottomed well before all of these projections. And again, the big question is why. And I think it's because the market always prices in information before it happens. So any information that is out in the marketplace, anything that people would call and ask us about, I mean, the market has already essentially traded for it. The market is a leading indicator. Even though those first quarter GDP numbers have not been released yet, I really don't think the market cares what the number comes in at. The market's looking ahead anywhere between 2 to 3 months ahead and 2 to 3 years ahead. And it's happened every time in history. Typically, before things hit rock bottom in the economy or with this virus or in the financial crisis, the market tends to move at least a few weeks, if not a few months, before the worst of the pain. So, looking forward, Matt, I think a big sign, obviously we're supposed to have Derby this weekend, this Saturday, and of course the weather is beautiful and sunny for it.
Of course.
Couldn't have found that out better. But, honestly, I think the Derby, the rescheduled date of September 5th, I think that's going to be a really big sign, at least socially. And it's kind of funny, for the sports world, the NCAA tournament being canceled really kind of, I think woke everybody up to how serious this virus was. And, potentially if we could have the Derby, go off without a hitch on September 5th, obviously crowds are going to be lower. We know that for sure. But if the Derby goes off, that might be a really big sign just, mentally and socially. And again, that's going to be something that, I think market participants are going to be looking out for is when can we start having these bigger crowds get together, some of these bigger social events, and really get things back to normal. Now, I'm going to throw out a potential negative here, Matt. And again, I think the market is well aware of this potential. I mean, we could very well have a second wave of viruses hit in the fall. And whether that starts in August or September or October, I mean, that's a very real possibility. And I think my big question, or I think everybody's big question is can we trade on any of this information and make it profitable? I mean, obviously we can, but, the market has priced in these possibilities already. So, I think for investors that were really trying to, wait for that light at the end of the tunnel, I can't tell you how many times we've heard that. And I pulled some of these tweets from a prominent investor. Anybody waiting for that light at the end of the tunnel, look at that date. That date is very, very close to when, the peak of the virus is hit. The market was already up 20%. I mean, if you're waiting for light at the end of the tunnel, you're almost always going to be late. So stocks nearly always move well before any of the good, news comes out. So, again, it goes along with our philosophy. Get invested in the market, stay invested in the market, come up with a risk tolerance that is appropriate for you. And if you got scared during this pullback, if you were able to at least hang on, maybe now's the time just to raise a little bit of cash and, again, ensure you're able to sleep at night. So.
Yeah, Keith, looking through these quotes, thinking about the economy is not so great and the market is up, it's always a nice reminder that you absolutely cannot time this. And I've always said that even if you can predict the news, you still can't predict what the market's going to do. It's just absolute craziness.
Yeah, so, it certainly has a mind of its own.
Given the context that we've sort of laid out, what do you sort of see with the economy? Any sort of themes or trends that we look for in the future?
Yeah, so our team's been talking about quite a few trends that we're seeing out there. Obviously, these are fairly fresh, and we're still trying to figure out the best way to attack them from an investment standpoint. But a couple of themes that we've come up with. We believe this theme was already in, I think the ball was rolling on going from truly a global economy to more of, quite frankly, a national economy. We saw this with the trade war. I think that was really what started that trend from globalism to nationalism. I think this virus, quite frankly, is going to accelerate that trend. I think we're going to see a lot of companies start to bring their manufacturing facilities back to the U.S. Soil. I could easily see international travel being quite a bit lower, obviously, for the next 1 to 2 years, but even 3 to 4 years from now. And people do have a way of forgetting things. So again, these are trends that we're going to have to kind of figure out over time. But I think the net effect of this is it's probably going to lower our what we call potential global GDP growth. And potential GDP growth is basically with all of our resources, in the world working at their most efficient capability, how fast can we grow this economy? And when you're taking out some of that cheap labor and you're paying higher wages to U.S. workers to have the dependability of those manufacturing facilities and to really lessen the chance of something like this happening again, quite frankly, you're lowering your potential GDP growth. So again, that's a big theme right there. Another fun theme we kind of threw in here was kind of that go local theme. So we went from global to national, now kind of moving from national chains to local chains. And I'm going to highlight a Facebook group. And on March 16th, I just went there yesterday and looked at the page. This page was created March 16th, and it highlights all of, it highlights local restaurants in Louisville. And, I mean, Matt, it's unbelievable. I think they have over 500 restaurants, like 400 or 500 restaurants on this Louisville Takeout Facebook group, and it has over 70,000 members.
Wow.
I mean, what's the population of Louisville? Is it 700,000 to 800,000? I mean, in the greater Louisville area, it's unbelievable. So, anyways, these pages are popping up literally across the country, trying to keep their local businesses, obviously in business. And so, we think this is awesome, and we think it's a trend that goes beyond the restaurant industry. It can really go towards nearly everything out there. So. Another trend, I mean, obviously, the vast majority of people, I am sitting here in my office. I'm part of our skeleton crew. But, telecommuting, this is just a fancy way to say, work from home. And, I looked up the Bureau of Labor and Statistics. Don't worry, I didn't go to the website. I'm not that much of a nerd.
Yes, you are.
Yeah, you tried to paint me like that early. So about 16% of the workforce worked from home at some point in 2019. And about 3 to 4% of that workforce works from home every day. So, Matt, 12 to 24 months down the road, I mean, is it likely that we see these numbers double? Could we see them triple? I mean, I don't know. I mean, I'd be curious to see how this trend plays out. Obviously, there was some setup that went along to having our employees at stockyards work from home. And that included, getting licenses to do WebExes. Obviously you may have had to go out and buy, an iPad or a computer or whatever it may be. I mean, there's a lot of money going around this trend. And then on the flip side, I mean, think about office real estate downtown. I mean, that's going to be hurting at some point down the road if this trend does double or triple from these numbers. So
definitely going to see an increase in those numbers. Yep.
Yeah, I mean, I really don't see that trend slowing down from here. Once you give people the ability to do something, it's difficult to take it away. So a lot of money going to be going around here, a lot of ideas kind of floating around in our head to see how we can take advantage. And, this last trend out here, I put deflation to inflation. Basically, the federal government and the Federal Reserve, essentially they created those monster stimulus packages to fight off deflation. And deflation is potentially the worst thing that can happen to an economy. If I think the price of a vehicle is going to be $5,000 lower 2 months from now, why would I spend any money today? And that is a trend that just continues on and on and on. And so I believe that's one of the reasons why the Federal Reserve basically came out and said, we will do whatever it takes to fight off, deflation, to prop up this economy. with massive amounts of liquidity coming to the markets, I mean, there is talk out there, that 3, 5, 10 years down the road that we could see some serious inflation issues from all of this liquidity. I will tell you that, at this point in time, our belief at Stockyards is that inflation is not a worry. We don't see that scenario playing out. The last 10 years, we've had massive amounts of liquidity, and we're lucky to have, inflation crack above 2% for more than a couple of quarters. So anyways, that's a trend that's out there. We are, at this point in time, we just don't see inflation as an issue. So, anyways.
With $2.5 trillion in stimulus, that's just a massive amount of money being injected into the economy, and it was needed, and I'm happy that we've done it because it looks like it's going to get us through to the next time period here. But you got to wonder, what is that going to do with prices and inflation? So very good. We've gone through the economy. We're caught up here. Let's talk about investing portfolios a little bit. The question on my mind: give me your favorite stock pick. Where should I put all of my money right now?
That's not even fair. So, Matt, this is one of our favorite questions from clients, and quite honestly, that's generally not how we manage money. We'd much prefer to have a balanced portfolio of stocks and bonds, and inside of that stock portfolio, we like to have balance again. So we certainly have some offensive plays in the portfolios we manage, and we have quite a few defensive plays in the portfolios we manage. And typically what we do is we may lean the portfolio one way or the other. So you'll see some of our big offensive plays. Cisco provides food for, a number of restaurants. So obviously if the virus ends sooner than later, restaurants open up sooner than later. People get out and interact sooner than later. And again, when I say sooner, I'm meaning sooner than what the market expects right now. So if we really saw things open up, towards the middle to end of May, and we really saw people actually, flooding, flocking out to restaurants, some of these plays are really going to work out well. On the flip side, if we see the economy start to open back up, we see that second wave of the virus hit, you're going to see some of those defensive plays like Costco, Amazon, and, some of those guys, they're going to continue to do well. And, again, so our portfolio is very well balanced where we have a number of plays on both sides. Obviously, we have healthcare stocks that have done very well. We have some energy stocks that didn't do well. So, again, we've, another big question that we get asked, Matt, and again, I am not promoting airline stocks. We will not be buying any at Stockyards. We're not going to be buying any gambling stocks. If you are really looking for something to throw in your Robinhood account, airline stocks and gambling stocks, banking stocks, all of those guys are very high risk, high reward. And if you're looking to, be very defensive, obviously any type of cleaning products, I've got to throw a question back at you. What's your favorite Netflix show right now?
Right now we're rewatching Breaking Bad for the second time, and it's just as good as the first time. So good. All
right. Well, I'm on Ozark, and we'll see. So
it's easy to see, with high quality names like this, why the portfolio has held up the way it has. So good job to you and the team for picking some high quality names here. And it is tempting, you look at the price of the airline stocks and some of these other risky names, and it is tempting to step in, and buy them at such a discount. So I'm happy to have you guys to lean on for some expert portfolio advice.
Yeah, so I'm gonna stop you right there because just real quick, a couple of these high risk names I have here. So airline stocks. If you would have told me the market is up 25 to 30% since March 23rd, I would have backed up to the truck to go into airline stocks and bank stocks as well. Those stocks are flat since March 23rd. So that's just unbelievable to me. I really, I don't see how that happens. On the flip side, the price of oil is down to $13 a barrel, and I'm not sure where it's trading at today. Energy stocks are up 50 to 60%, and I'm talking the likes of like Chevron and Exxon, some of your blue chip energy stocks up 50 to 60% over the course of the last month. So, like I said, picking one stock, we're just never going to do it. We're never going to have success at it. So, yeah. Anyways, I just wanted to throw that tidbit in there.
Well, and we talk about these numbers just so casually, and it's hard to put a real context about how massive these movements are in the market. We've seen trading days in excess of 10% per day, and it's just so shocking to us in the industry that are used to much, much more subtle moves. Yep. Incredible. So we've had a great run. We've had a long run. The market has gone straight up for 10 years. We just ended the longest bull market in history. And, what expectations, what would you have me expect in my portfolio in terms of returns over the next 5 to 10 years?
All right. Yeah. So that's a heck of a question. And, again, I always like to go back to the building blocks of stock returns. And there's really 3 major building blocks. The first building block we always look at is dividend yield. And so that's, again, just, the amount of cash companies throw off or the market throws off in a diversified portfolio. The rate of inflation is a major, part because investors want to be compensated for that rate of inflation that's going to happen. And the final part is GDP growth. And so this essentially replicates the amount of earnings that companies are able to make over top of inflation. So when we add in those 3 rates, or those 3 building blocks, if you will, that gets the vast majority of that 11% that we've seen from the market. And again, these numbers only go to 2007. I didn't feel like, updating it, but since I think 2007, the market's up 8 to 10% a year since then. So again, I think the numbers still hold true. Now, the interesting thing, dividend yield, inflation, and GDP growth are very, very predictable. And that's measured by standard deviation. That is just a fancy word for volatility. So the real driver of volatility, the real driver of the market going up and down as much as it has, is PE expansion, and that's basically valuation ratios. So let's just strip that out and look to where we're potentially heading over the next 5 to 10 years. Dividend yield out of the S&P 500 is close to 2% right now. However, it's widely expected that quite a few dividends are going to get cut because of the drastic drop in GDP, the drastic drop in earnings. We're going to go ahead and just be conservative, tack on 1.7, 1.8% for dividend yield. The rate of inflation, again, this is not a major issue for us. We don't see inflation running away at this point in time. So we're going to, kind of go back to that status quo. If we can get 1.8 to 2% inflation, we would be pretty happy. And again, GDP growth. Before the coronavirus, we were forecasting somewhere around 2.2% GDP growth for the next 5 to 10 years. Again, I think this virus kind of sets us back. I think we lower that just a little bit. And when you add in those 3 numbers, with the market trading at, basically average valuations, maybe slightly above average valuations, we think that's going to be about 5 to 6% type rates of return on the market. So, adjust your portfolios accordingly. Don't extend out for risk. I think that's just where we're going.
Wow. I mean, that's a pretty big difference from what we've experienced over the past, several decades. But it's a good thing that we can model these into our financial plan, account for, a number of different scenarios, and make sure to put the right strategy together.
Absolutely.
Keith, it's been a pleasure. Always a pleasure. Always learn something when I chat with you. Thanks for spending some time with us. And I'm going to turn it back over to my co-host, Jason, who's going to introduce my fellow Arkansan. Go Hogs.
All right.
Hogs, I'll call them. Don't tempt me.
Yeah. Thank you very much, Keith. Thank you, Matt. You guys summed it up pretty well, although you did go over by about 10 or 15 minutes. I think I'm going to have you guys are going to have your own show on a weekly basis, so that way we can get through everything else. But no, much appreciated. I'm hoping that everyone that's listening today, they were able to get something out of that. We'll have questions at the end. So if anyone wants to follow up with anything that was specifically mentioned or has a question about what they heard there, we'll have questions at the end. I did want to bring on Jon Sanders. He was nice enough to join us and accept the invite to be a part of our WebEx. And we thought it was timely given where interest rates have moved over the last month to almost 2 months now. And, at times the interest rate environment for mortgages has almost been as volatile as the stock market. We've seen some ups and downs with those rates, but right now they've seemed to settle at a pretty low spot. So I'm going to kind of let Jon, tell us where, rates are currently at today for those of us that, maybe we're sitting on an arm out there. Is it a good time to shop and find something that's fixed? Are we going to get into, a pretty good rate now? If you could just kind of bring everyone up to speed of what we've seen.
Yeah. So we've seen a lot of volatility, just like we've seen in stocks, but it's balancing out and has been on the low end. Rates are still very low. If we would have been having this conversation back in December, rates would be 4.25%, possibly a little higher depending on the scenario. As of today, 30 years are at 3%, 15 years 2.8, 2.7, depending on the scenario. So despite the volatility that we have seen, rates have remained really stable. A big part of that's been the Fed kind of stepping in, stabilizing mortgage-backed security markets to kind of keep things stable on the rate side, because we were seeing massive volatility, like you were saying. I mean, we would have days, back in March where rates would jump 0.5% within an hour. So I mean, it's really kind of settled in and likely settled into the lower end of the range we've seen. Okay.
Now, tell us though, obviously there's all the volatility out there. It's being caused by COVID-19 and that's affecting many other things. But, for mortgage servicing, what are the impacts that you're seeing with your operations, getting things done? Are loans still being closed timely? Are there any issues there?
Yeah, we're seeing some issues with other lenders. Stockyards being a local company and having plans in place in terms of people working remotely, things are, in terms of processing, moving quickly. Where we see delays are things like appraisals. And the big players, Fannie Mae, Freddie Mac, have come in and given lenders options on certain properties where we can waive appraisals, which have helped a lot, and things can turn around in a matter of weeks. But in those cases where an appraisal is required, it can cause issues. People aren't necessarily super thrilled about somebody they don't know walking around in their house for 15, 20 minutes. So that's something that people need to be aware of, that we are seeing. And just overall turn times can be a little slower, just given what's going on with attorneys and appraisers, but it's still in the range. Typically 30, 45 days is mostly still what we're seeing in most cases.
Okay, so once they lock a rate, they're safe. It might take a little bit longer than normal, but they're going to be safe with the overall process.
Because we'll lock a rate even longer than that. In these scenarios, we'll lock a rate 60 days. So as long as, once we're locked, we're fine. If it takes a little longer, you don't have to worry about the rate going anywhere. I mean, even if it took 50 days, we're locked in.
Okay, well, that's good. Tell me a little bit about, if I'm a first-time home buyer or I'm new to the market out there and I'm shopping for a home, are there any programs or grants that that buyers might be eligible for that are still existing or that have come about?
Yeah, there is. There's a lot of really good ones. And a handful of them don't even have to be a first-time home buyer per se. I mean, there's programs out there that we deal with, Stockyards, as a member of Federal Home Loan Bank out of Cincinnati, with Welcome Home Grant Funds. We're to offer $5,000 to home buyers. If you're a veteran, you can get up to $7,500. There's going to be income restrictions based on household, things like that. But it's available every March. We get allocated a certain number of funds. It's probably a good time if you're interested in grant funds to start preparing for that specific fund starting next year. It's been out for a little while and could run out soon, but it's been coming out every year. On top of that, Kentucky Housing Corporation, which is a program that's available year-round, will offer down payment assistance of $6,000 to help people get into homes. So yeah, there's a lot of really good programs out there that we deal with.
Okay, well, that's good to hear. Now, myself being a financial planner, and we're on a WebEx, and a lot of the callers are our wealth management clients. So a lot of them are, they're all very affluent. I'm often doing financial plans, and when we're going through a financial plan, probably one of the number one goals is, or one of the more popular goals is, I want to buy a second home. And in the past, we've seen interest rates on second homes be, gosh, anywhere 100 basis points above and beyond just what your primary home would be, purchase would look like. Are we still in that kind of same arena, or has that changed at all? Have those rates come down even if you're looking to buy another home out there?
Yeah, we're seeing second home interest rates really price out about the same as a primary residence. We see a big shift when it moves over to an investment property, but on the second home, we're not seeing huge adjustments. So if we're going to stay in, and we may jump on this topic in a second, but if we're going to stay in the conventional scenario, and it gets a little tedious here on loan amounts, but again, 5, 10, 400 is going to be that number they're looking for. One of the issues we've been seeing on the servicing side is lenders, trying to change their risk assessment and minimize that risk by not offering certain products. We're seeing jumbo investors where if you wanted to buy a house and the loan amount was going to be over that number, they're not offering them. Certain cash out refinances by other lenders are not being offered. Stockyards are still doing them. On the jumbo side, that's where we're seeing the biggest switch. So we do have investors that are offering jumbo mortgages. It can be specific on loan amount in that 650 to 750 range on primary residences, not on second homes. So again, just with everything moving quickly, those investors can change those guidelines, but there's still products out there that we can get clients into if it's in those ranges.
Okay. Well, I mean, that's good to hear. So I think probably best suggestion for that if you're in the jumbo market is to reach out to the mortgage loan officer and,
absolutely, and have a conversation.
See where we are with offerings out there. Okay. So one of the other biggest things we often get when we're sitting with clients and we're talking through things is closing costs. And, it's always the bogey out there that everyone's trying to work their way through. We know we have brokers out there that are throwing out teaser closing costs, but there's got to be something more behind that. There's no way that they're making money off of offering $250 in a closing cost and, running a business and paying everyone. So take us through, when a client's comparing, how do they compare apples to apples of, a product that we're offering versus maybe a broker out there? What should they really be looking at to make sure that they're not having one pulled over on them?
Yeah, I'd say the first thing that you'd want to do is get an official loan estimate from each lender. So that official loan estimate's a legal document that a lender will have to disclose after you've applied within a certain time frame, and that will give you, and again, no matter the lender, that loan estimate's going to be the exact same document. So you can compare those two together. A lot of the times what we'll see, if someone is, like you said, Jason, offering, no closing costs, the costs are getting paid one way. It costs to do the loan. And a lot of the times we see it built into the rate. And that's a fairly normal thing that we will see on those costs. So a lot of the times it might be lower in upfront fees or fees that could be rolled into the loan amount, but that rate's going to be slightly higher. So we'll look at those, look at points that are involved, and kind of go line by line through that loan estimate together. But a lot of the times that's what we're seeing.
Okay, fair enough. Yeah, I guess, that covers a lot of the more popular things that we're hearing out there. And I don't know if John, is there anything that, I overlooked and didn't address that you're seeing on a daily or weekly basis that you?
No, I think that a lot of people, although underwriting guidelines have shifted a little, there's a little more background work that's got to be done on employment. We're doing verifications of employment on borrowers right before closing. It can be a little more tedious, but we're still making loans. You see some people out there, saying, banks aren't making loans anymore. Stockyards, is still making loans. We're doing a lot. So yeah, we haven't stopped there.
Okay. Well, good. Again, very appreciative that you're able to join us today. We thank you for that and providing some insight to those that are listening. I'm sure there's at least a few people on the phone line that have probably thought about their own mortgage rate, and hopefully today's conversation will at least spark or motivate you to at least make a phone call and figure out if a refinance or if you were looking for a purchase, is the right time. So with that, everybody, I want to wrap up today's WebEx. Again, we're really appreciative that you joined us again for another week of it. Moving forward, I think we're going to skip next week. As Matt said, Keith likes to play a lot of golf, so I think next Tuesday looks really nice and he wants to play some golf. But now, joking aside, We're going to probably go to a bi-weekly and kind of see how the markets play out here, what news is coming out, and we'll do some future presentations off of, continue to do future presentations off of what's relevant and what's happening out there. And then as things settle down a little bit beyond that, we will get specific with some financial planning topics, things to be thinking about, when you're sitting down with, your spouse, children, having a conversation around your own, personal household finances. We want to continue to bring topics to your household that make sense, help you on a daily, weekly basis. So we'll continue coming up with some great ideas for you. Again, I always offer up the suggestion that on the bottom left corner of this slide, if you can see it, it's WMTquestions@syb.com. Throw questions at us. We're happy to address those. If you have suggestions on topics, we'd be glad to look at that and do a future WebEx with one of your topic ideas. So with that, if you're online via web, you can chat a question into us. If you're on the phone lines, you can *6, unmute your phone, and ask questions. We'll take questions now. I know when Keith was talking, one question did come through, and it was asking about mutual funds versus stocks. And, and in their portfolio, they have a lot of mutual funds over stocks. I think the comment there is it's really largely dictated by the size of the account. But at the end of the day, we're picking mutual funds the same exact way we're evaluating stocks, looking for all the same core qualities. And I don't know, Keith, if there's anything for you that you'd like to elaborate on, but we don't do anything differently. But because oftentimes it's a smaller account, we might use funds to make sure that we are broadly diversified and not too concentrated in any asset class. Anything else you'd share on that, Keith?
No, our performance with the mutual funds we use has been really, really good. We've had a lot of exposure to some of the growth companies like Amazon and Apple and Facebook, and those names have really held up well throughout this downturn. So again, you're getting just as much protection from some of those mutual funds that we have in accounts as you are from some of the individual stocks. Again, our team has just done an amazing job throughout this downturn. And again, this is typically the times where we start to show our stripes is when the market's down. We tend to, provide a little bit of extra protection. And, we've certainly done that this time around as well. So like I said, now you said it perfectly. Our screening process is very, very similar. And we're looking for managers that manage money the way we do. So.
Okay. Yeah. I've got a question coming in. So given what we see in Q2, why wouldn't one put more in cash and then jump back in late Q2 or early Q3? It's clear the stock market will dip in Q2.
I'll take that one.
Go ahead, Matt.
Go ahead, Keith. Well,
no,
Keith, okay, so let's go back to, that slide where you had where the second quarter GDP looks really bad, and yet the market has gone up 30%, over the last month. So you can't time it, and Keith, you probably have some follow-up points on that. But like I said, even if you can predict the news, even if you can predict the economic activity, you cannot predict which way the market is going to go because investors are pricing in future information.
Yeah.
Yeah, I mean, I would absolutely agree, Matt. And again, just looking at some of these, quotes here, I mean, stocks always move ahead of the news. So, again, unless if you really think that things are going to get bad, the market would certainly trade down if we have a second wave of this virus. I don't think anybody knows that for sure, and the market at this point doesn't seem to be pricing in a serious second wave, but potentially a second wave is already built into those market prices. So, again, I don't think you can time the market. You've got to make too many right decisions. So.
Yep. No, I'd absolutely agree. And, every client's going to have maybe a slightly different answer to that. So those that are much closer to retirement or well into retirement, we might answer that a little bit differently. But more broadly, what Matt and Keith are saying makes absolute sense. And, we don't have a chart here to show you that, but if you go back, there's white pages out there of investors that go in and out of the market, kind of using very logical foresight as what's referenced in the question, versus someone that stayed in the market during that time period. They're usually, the individual that stayed in the market has almost always outperformed the individual that, used very logical foresight. But as Keith referenced, the in and out timing is just almost undoable. I mean, it's almost impossible. So does anyone have are there any questions from the phone lines out there? All right. Well, with that said, I want to thank everyone that's continued to join us each week. We're doing our best with technology to make this a better experience each week. I want to thank, Matt and Keith being part of the investment team and the entire team. I think it makes up 17 or 20 individuals that are on that team. And they've worked tirelessly through the last couple of months trying to figure out what's best for our clients when we were choosing mutual funds, when we're choosing index funds, when we're choosing stocks. That hard work it's definitely paid off. I think most of our clients, I think all of them would probably say that they've been very happy with the overall performance. We've tried to do our best to keep them out of danger while they participate on the upsides. And that's what we're here for, to be as prudent as possible with you. Again, I'll tell you, if you have any questions, please feel free to make sure you reach out to your advisor. You can use the WMT questions at syb.com. We're happy to address any questions through there. Otherwise, like I said, this will come out on a recording and we'll show the presentation later this week. And then look for your next WebEx invite in about 10 days. And we'll have a WebEx on Tuesday, gosh, whatever day that is, May. I don't have a calendar in front of me, but the second Tuesday of May, I think it's the 12th, we'll probably target another WebEx there, and we'll have an idea of what that topic's going to look like here shortly, and we'll have an invite go out. So again, just want to thank everyone for joining us. Hope you have a great week, and stay safe and enjoy your time with your families. Take care, everybody.
Thanks, everyone.